It's almost time. Is the huge economic downturn right around the corner? Well, let's get into some information today, and we're going to answer that question. By the way, my name is JJ, and you're watching Bull Boom Bear Bust, and we're back with another dose of economic reality as usual, right? So this whole economy, let's just take a step back for a minute. The whole economy has been propped up on deficit spending via the government, debt accumulation via the U.S. consumer. Uh, Ultra low interest rates for 10 years brought us to where we're at now. 2020, this whole thing should have came down, but instead they injected so much liquidity into the system that all the money ever created has been created in the last 5 years. Half of all the money created, I mean, rephrase that. Half of all the money ever created was created just in the past 5 years. That's the statistic that I read. And I've got some other news here I want to get into today, some statistics, the housing market, the debt situation. Let's start off, though, with the stock market. We've got Starbucks down 12% today. Why? The coffee chain is slashing their 2024 forecast amid same store sales drag. So, another uh, piece of the puzzle there. Consumers are pulling back on spending. And the spending that we did see in the previous months, a lot of it was just because prices were higher. A lot of people couldn't connect the dots. They couldn't compute that the reason spending was going up is because people are just buying the same things they always have bought, but they're just paying more. Right now, we're seeing sales drop, so people are cutting back. By the way, a lot of people are cutting their cable, and there's a huge outflow of cable subscribers. We're going to talk about that. But first, Starbucks on Tuesday reported weaker than expected quarterly earnings and revenue, fueled by a surprise decline in same store sales. Who are the people in this economy buying three, four, five? I don't know how much they cost now. $5 lattes. The coffee chain also slashed its forecast for fiscal 2024 earnings and revenue, predicting that its cafes would keep underperforming for several quarters. There's only so much the consumers can take, folks. I said it here. A lot of people are surprised how long this economy has been chugging along, considering the state of the U.S. consumer right now is so much more debt than we had even back compared to the financial crisis. We're about 30% higher consumer debt. And, the population hasn't grown by 30%. So it's not just that there's more people, but not just that, the average debt per person is also much higher. And interest rates now going into this debt mountain are not coming down. The rate cut hopes have been basically slashed because, as we talked about here, as we said, what happened? The inflation numbers came in higher than what the quote unquote experts expected, even though all of us here, you and I, we all knew that this thing was going to continue to get worse. What's one of the phrases I've been saying for years now? It's going to get worse. It's going to get worse. Inflation's going to get worse. So when you say economic correction, people often assume that prices will crash. Under normal circumstances, yes, prices would have crashed by now. But all the intervention, all the propping up of the markets has kept this housing market, has kept asset prices elevated. Folks, bottom line is it really looks like the consumer is starting to crack. And it's not just me saying that. Take a look at what McDonald's has to say this. McDonald's and other big brands warn low income consumers low income consumers are starting to crack. Executives at some of America's largest companies have said that consumers feel the pinch at higher prices. Folks, we all knew this was coming, right? Consumers, people like you and I, we can't go into endless amounts of debt like the government, right? We don't have unlimited deficit spending and we don't have unlimited borrowing powers, and it can never be paid back, folks. Imagine us going to get a loan at a bank, borrowing money to no end, with the bank knowing we don't have a job, we don't have income, we can never pay it back, right? That's essentially what's happening. Executives at some of America's largest companies, consumers are buckling. The remarks come as sticky inflation poses a challenge for Main Street, Wall Street, and the Fed. Inflation has dominated corporate America's discourse over the past 3 years. And of course, you all knew this again. Nothing is being done to actually fix the problem. Banks are still loaning out money, allowing people to go further in debt. When the banks stop lending or when they make it harder to get a loan, and when credit card companies stop increasing the credit ceilings, then it hits the fan, right? And I know there's a few people out there, I've seen you in comments, you said your credit card company, they drop your credit limit, a few of you, but that's not the majority. Most people are still getting credit line increases, even though delinquencies are starting to really jump up. And it's really the opposite of what should be happening. When delinquencies start to rise, banks should be more concerned and they should start dropping the credit limits. They should start lowering these credit ceilings, right? To brace for what's coming. But we have an environment right now where the banks are not concerned about delinquencies. As crazy as it sounds, I know it sounds completely bonkers, but we're in an environment right now where banks are not concerned about the defaults, the amounts of loans they're loaning out. Even the banks that are failing, they didn't take any precautions to stop giving out loans. The bank that failed, last week, the banks that failed last year, they were giving out loans and doing business up until the point of failure, right? They did not brace for impact. They didn't do anything to try to mitigate the situation with the deposits leaving their bank. That's the environment we're in. The CEO is making so much money. After just a few years, the CEO has hundreds of millions of dollars. They don't care if their bank fails. It's a golden parachute. They're just going to go work somewhere else with a lot of money. I'd put it that way. We're in an environment where the big wigs at the top are making so much money. They don't care if their company fails. That's the way I think. And they know they're just going to get bought out by another company, so therefore they're not going to get blamed. Though the pace of price growth has cooled since the Fed began raising interest rates in early 2022, consumers are still feeling the squeeze, of course, because price is going up. They're going up. Prices are going up. Consumers have to still feel the squeeze because prices aren't coming down. If prices are going up, but the pace of going up has slowed, that doesn't help anybody, right? It's not as bad as it could have been, but it doesn't help anybody, right? So let's say you get 5 bee stings in one day. You walk next to a hornet's nest, I got 5 bee stings. Right, the next day you only get 4. Right, so you could look at it optimistically and say, well, it's not bad. Yesterday I got bit 5 times or 5 bee stings. Today I only got 4 bee stings. It's great. That's the positive way. But the way I think most people would look at it would be like, wow, 2 days in a row I got stung a lot. This is bad. When is this going to stop? The consumers are getting stung right now with high prices, and there's no easing the pain. We're starting to see signs of a housing bubble going bust in at least 2 states. And could this be the beginning of something bigger? Home sellers in Florida and Texas are slashing prices amid excess inventory. Folks, what have I been saying here for 2, maybe 3 years, maybe 4 years, since 2020? I said the states that saw these huge inflows from people from California, people from New York, people fleeing these high-cost states, one of the biggest places, or 2 of the biggest places, were Florida and Texas. Those were 2 of the states that saw the biggest inflow, and therefore they saw their home prices go up faster than most other states. And what did I say? I say those states are going to become the new bubbles, and they're going to be the new California, the new pick your state. Home sellers in Florida and Texas slashing prices amid excess inventory. Priced out buyers are relocating to more affordable states like Tennessee and North Carolina. So now, will those prices shoot up in Tennessee and North Carolina? But here's what's happening in Florida. I'm just going to pull up a couple charts here on some inventory coming out of Florida. Right? Let's go to Orlando here and see what's happening with inventory here. All right, so we see all the way to the most recent numbers here, March, over 9,000 homes for sale. Folks, at the low, it was 2,500, right? So we've tripled inventory in many cities. This is just one. By the way, this is the greater Orlando, Kissimmee, Sanford, Florida metropolitan area. So look at this, folks. This was declining all the way up until 2022, and exactly what we predicted, a big spike up in inventory as people are feeling the pinch in Florida. Look at the cost of home insurance now, especially in Florida with all the hurricanes. Homeowners are buckling under the pressure of high costs, whether it be the insurance, the utility bills, the maintenance, the upkeep, the taxes on the bubble priced homes are starting to take their toll on homeowners. Florida, again, this is just the beginning. Texas is starting to happen. And this article points out some Texas information as well. A whopping 48% of listings in Sarasota had a price cut. Tampa close behind at 44%, Cape Coral 41%, Orlando 35%, Jacksonville 33%. So a lot of price cuts, a lot of people putting their home on the market, and inventory has tripled. So that lets you know the pain is beginning in Florida. Now, Texas, realtor said, quote, last year was by far the slowest market I've seen in 20 years as a real estate agent. Move-up buyers are almost non-existent. Even though a lot of homeowners have built up a ton of equity, many don't want to sell because their monthly payment would be double or triple due to higher mortgage rates. And that's the thing, too, about high rents. A lot of people are choosing not to sell because they look at what the rents are, and you might sell your home, and sure, you're going to have some cash from some equity, but you're going to be paying rent that was probably as high or maybe even higher than what your mortgage payment was, especially all the people that got locked in at 3.5%, 4% mortgage rates. But Texas is just starting to feel the pain too. I think we're going to see some big inventory surges going on in Texas. In fact, take a look at what's going on in Houston, something very similar to what we saw down in Florida. The inventory got as low as 10,600 as of the last report. We're at 21,500. So over a doubling there, not quite as bad as Florida. A lot of the cities in Florida saw a tripling of the inventory, but a doubling of the inventory in Houston, right? So the lower and the declining inventory is starting to reverse. And we noticed this last year. We talked about it, but it's going to continue to go up. And there's no easy way out of this. Homeowners are not going to get some lifeline. I mean, you could say that, okay, maybe they'll do some massive mortgage forgiveness program, but folks, in a world where they do massive mortgage forgiveness, that means a lot of other things went really, really wrong. Maybe a complete social, economic collapse would justify such drastic measures where they start forgiving mortgages, right? So hopefully we never enter a world like that. Hopefully we'll just see a typical downturn where the bubbles finally burst. Banks are finally cutting back on the loans they give out. Credit card companies are no longer letting people go into endless amounts of debt. That would be what would happen in a normal world. And I say normal, that's what happened in previous economic downturns. Well, those things aren't happening now as far as the way the banks are operating. So that's why things are so much different now and taking so much longer, right? So there's reasons behind this. It's not just, flip the coin. There's reasons why things are playing out different this time than they were. Look at this headline here. The U.S. already in recession. And we're following the same path as China by becoming, look at this, reliant on debt. And that's a veteran forecaster that's reported by Business Insider. Reliant on debt. Well, I'll tell you what, if it weren't for debt, the economic boom that we saw over the past 10, 12, even 14 years, ever since 2010, would have never happened. What do low interest rates enable? Why do we have rock bottom interest rates for 10 years, folks? They wanted people to borrow money. And yes, you could borrow more money at lower rates, of course. They wanted people to borrow money. They wanted this fake economic boom to occur. They wanted the price bubbles to go back up to where they were and even higher. If you look at home prices now, double where they were in many cities compared to 2008, right? Back in 2010, 11, and 12, people looked back at the 2008 housing bubble and they said that was insane. They said, how did banks ever let that happen? How did the regulators let that happen? Here we are now, things are twice as bad. And people thought it was insane back then. But now we have people thinking that, okay, this is the new normal. And that starts to happen after a certain amount of time. You see prices stay stuck or stay high. And you start thinking, okay, this is the new normal, right? But take a look at what's happening here with some home prices. And I just want to bring up a few charts here. I'm going to start here with my hometown here, San Diego. Technically, I'm on the outskirts, but I still say San Diego. I'm in a suburb of San Diego. And I want you to look at this pattern and see if you notice the same pattern in other cities. First, I have to find it. Where are you? Here we are, right here. San Diego, look at this. This is a double top. There's one spike, drop, another spike up the following summer, which was the summer of 2023. And look at this. If you look to the right edge here, there's another small spike up. And what Wolf Richter, this is Wolf Richter, by the way, his website, what is it, wolfstreet.com, he calls this rate cut mania. So remember all the talk? There were going to be 4 rate cuts, 5 rate cuts, 3, 4, 5 rate cuts this year. Well, this is what he refers to as rate cut mania. And if you look at the Case-Shiller Home Price Index, as also outlined here out of Wolf Street, you see the spike up here to the right. So we had the high last 2 summers ago. We had another high and rate cut mania, keeping the dip from occurring this last winter, right? So that is coming to an end. We're likely going to see some big noticeable changes in the real estate market coming up here later this year in the summer and into the fall, right? So typically summer is a really hot time for real estate. A lot of people buying. So we're going to see how it goes, right? But we see these patterns are emerging, they're developing, and things are starting to look very familiar. Like if you're an investor, you recognize that double top pattern where it spikes up, it drops. Then there's the second wave of hope and optimism. It sometimes reaches the previous high, and then sometimes it goes past it, but then it comes back down. And I think we're on the downside of that now. And after the double top, typically that's when you see the acceleration to the downside. Now, again, anything can happen, right? They can throw all kinds of rescue programs into these markets. There can be emergency rate cuts because something scary, something unexpected happened. Pick your poison, right? Is it going to be cyber attacks? Is it going to be war? All right, back onto the topic of consumers that are tapped out and they're looking to cut back on their expenses here. We've got a huge outflow from Comcast Cable Company. In fact, Comcast lost 487,000 TV customers and 65,000 internet customers in the first quarter. I personally know people that have cut their home internet and they just do everything on their phone. They watch videos on their phone. They pretty much everything they used to do on their computer, they're now doing on their phone. When it comes to typing up Word documents and stuff like that, I couldn't imagine doing that type of thing. But as far as internet connectivity, a lot of people are cutting the internet and the cable, almost 500,000 out of Comcast. 487,000 lost customers, folks, just in the first quarter. In a 3-month span, almost 500,000 people leaving Comcast cable. Annualize that, you're talking about 2 million lost customers. So Comcast, I wouldn't be surprised to see a lot of layoffs being announced here in the very near future coming out of Comcast. It says here, cord cutting is continuing to hit Comcast hard as the company has recently lost both TV and internet subscribers. We just went over those numbers. That works out to 5,300 lost subscribers every day. Quote, our team is continuing to execute exceptionally well in a dynamic and competitive marketplace. Well, it's competitive, all right. If you can find customers that have the money to pay for your overpriced cable. I say overpriced because when I had cable, I believe it was got up to like $140 a month. And we cut it now. We just have a few apps on this little streaming device. And some of the apps we pay for. But when you look at the cost, I mean, we're paying less than $50 now a month for a few select apps. And congrats to you out there if you have no apps. If you have 0 apps and you're surviving, I could survive without TV. I could survive without apps, but my family can't. Kids, they like these certain channels with certain cartoons. My wife watches certain TV programs that she's got to have. Otherwise, maybe she'll go through withdrawals. I don't know. But I think people are addicted to some of these TV shows, this programming. Anyways, wanted to put that out there, folks. Consumers starting to crack. We heard it from McDonald's. Go back to the beginning of the video. What was the first news story? We talked about Starbucks warning consumers are starting to crack. Comcast cable, obviously you're losing 500,000 subscribers in just 1 quarter. Consumers are starting to crack. The states that saw the hugest run-ups in home prices over the past few years are starting to see sellers list their homes and it's going to continue, I think, into the summer and into the fall. We're going to see how it goes, and this could be the big one this year, folks. Let me know what you think about this down in comments. Everybody keep stacking. Bye for now. Hope to see you on the next video, right? Please make sure you're still subscribed. Talk to you soon. Keep stacking. Peace.